Per usual, everything on this channel is for educational purposes only and is not intended as financial advice. I haven't talked about miners exclusively in a little bit. Last time I did that, I think, was August. Yeah. I came away from that video saying I really liked CleanSpark. Since that video, they've done really well. This video, I'm going to come away saying I like Iris Energy. I don't own any of these miners at the moment. I don't even own WGMI at the moment on this day, February 17th. That'll probably change next week. But just as full disclosure, I'm not Mike Alfred where I've got millions of dollars in equity in these companies, okay? We've got a Discord now. Shout out to Doppel, Matthew Golf, a few others helping me do research on stuff like this for these videos. Just tons of great traders and investors in the Discord talking all this stuff out. So I'm not going to go deep into the background of mining and how we got here. If you want more info on that, watch this video from 6 months ago. I will link that in the description of this video. I will link all of this stuff in the description of this video. This is more or less a way for me to think about the miners and to talk about it, to get the juices flowing for other people, things to consider here. The biggest reason to trade the miners is they have outperformed in a bull market historically in the past. I'll talk about why that's probably going to be different this time. We'll look at some data on that. We've got halving coming up. That's important to consider. Do the big miners overtake the small miners? Are there more mergers and acquisitions? Do miners pivot to AI and hosting capabilities there? In my eyes, just because I'm so acutely aware of it, there is massive regulatory risk for these miners, especially because a lot of them are concentrated in the United States. A lot of them are in the South. A lot of them are in red states. A lot of them are in Texas, which thus far has shielded them from regulatory dabbling, let's say. Those states have kind of embraced those miners. These are just risks to think about when you're investing in this stuff, right? You don't want to get hit with some headline that so-and-so state has outlawed mining, right? As what kind of happened in New York, upstate New York. We'll talk about that. Miners are generally short energy and difficulty. They want cheap energy. They want difficulty to go down. Energy in some ways has gotten cheaper depending on the energy mix that they're using. In some ways it's gone negative for some of these miners, or free if we're talking about methane flaring. Some of these miners are using that. I think Marathon, probably the biggest among them, dabbling in that stuff. They're also long Bitcoin price by default, and they want high fees, so they're long high fees. They're long more fees, right? The more fees they collect, the better their revenue. They're kind of acutely sensitive to ASIC efficiencies, as in they want the best ASICs for the cheapest price. There's lead lag times with buying them and shipping them and installing them. I talked more about that in the last video, but that's also something to be aware of. A lot of these miners now have a treasury as well. Many of them had a treasury 6 months ago, but specifically CleanSpark has started building up their Bitcoin treasury. That may further help amplify the upside, right? Or the downside if price goes south. Again, something to look at and consider. It's hard for me to know exactly how to plug that into some grand equation, right? Where we can say, here's regulatory risk, here's the treasury, here's hash rate. So I think it's just knowing that this is what exists. It's important to talk about it. I'll talk about beta and volatility as we get towards the pricing of this stuff. The TLDR here is, look, you don't want a full portfolio of beta. You just don't, because if this stuff does go south, it's going to get ugly, as we've seen in the bear market. You do not want to be holding this stuff in a bear market. Absolutely. There's obvious evidence for that. You don't want to hold none of this either, realistically, because it does have amplification on the Bitcoin price historically. These miners have been great trading vehicles. WGMI, the ETF I'll talk a lot about, has been a great trading vehicle. For the past 2 weeks, when I look at the NASDAQ top 10 traded, I see 3 or 4 miners each day. I mean, it's wild how much trading activity the miners are generating. So there's risk versus reward to consider. And to some people, this is their altcoin. Miners are their altcoins. Miners are where they go for the extra added risk. There's also other stuff to talk about and consider. Coin, MSTR, I'll look at that a little bit. BitX, I didn't bring up in the data because there's just not a lot of trading history for BitX. BitX is the 2x Bitcoin ETF. It's something else to consider. I've preferred that recently, and CleanSpark has done better than BitX, right? MSTR better than BitX. So I would have been better off not holding BitX, right? But that was just my choice. A lot of guys also talking and looking at trading the crap out of options on this stuff. CleanSpark options did really well, Marathon, etc. I'm not really going to go into business fundamentals. That's really not my strength. There are some great sources on that I'll mention. To me, the most important thing is always going to be hash rate. I don't really care about debt. I don't really care about overhead, me personally. I know it's important. You should be aware of it. I don't really care. I'd rather look at the charts than go through some earnings statement. And then lastly on this list, the nuclear piece. I think in order to progress as a society, we're going to need nuclear. Bitcoin's going to help us get there with nuclear. In order to meet energy needs, it's safer than coal, safer than hydrocarbons. Solar and wind are not enough to meet the EV demand, for example. So all this collectively is this interesting intersection of geography, regulation, energy, hardware. I'll hit on that a little bit. So we're talking about allocation for dummies. This was one thing I suggested in the Discord. Like, let's say you have some tax advantaged account where you want some exposure to some of this stuff, depending on your risk, right? Depending on your volatility appetite, okay? So maybe you'd put a slug into the ETFs. Maybe you want some coins, some MSTR, some Square, some Hood, some PayPal, right? Whatever. Again, just an example. Maybe you want to bump this up a bit, depending on how much BTC you already have elsewhere, just as an idea. But I don't think you want 100% CleanSpark, okay? Because that's just going to be quite the journey. I mean, you have to be aware of the volatility here because the volatility will blow your hair back from week to week, which is one reason why these are great trading vehicles and it's harder to hold through them, at least thus far. When we get to the TA half of this video, a lot of the TA is lining up towards what you'd expect, which is bullishness into halving based on Bitcoin's bullishness post-halving. If you don't know which miners to select or you don't care or you want somebody to do that for you, there's the WGMI ETF. I'll look at those holdings. That's professionally managed by Valkyrie. There's a fee for that, but you get a little bit more than just miners. There's some chip stuff in there. There's NVIDIA in there. So there's other stuff in there that's kind of miner adjacent in a different way. You can also stick to the top names. Like, realistically, these are probably going to be the best 3 to come out of halving. You're going to have some dark horse at the bottom, like TeraWolf. That chart looks like absolute garbage. They're talking about burning tires and for energy, some weird stuff going on there. Okay. So maybe they do well. I don't know. That's kind of a gamble. Again, it just goes back to your risk, right? Then lastly on this, the rebalancing considerations, there's an argument to let the runners run, especially coming off of halving. Miners historically have done best post-halving. Something else to potentially manage would just be the calendar year, right? Do I rebalance this quarterly, monthly, yearly? Do I look at the BTC ratios and decide based on the range or the TA? Do I think this can go higher? Do I think this should go higher? Because it's inevitable, I think that, this miner slice, let's say you started with this today, I think it's inevitable that this miner slice could creep to like 30% of the portfolio potentially or more. I mean, it could get pretty bullish in an actual real deal post-halving bull market. Something else you could do is just follow BlackRock. Okay, BlackRock, this is old data, right? I think they just picked up even more miners. This is as of August last year. They have pretty decent slugs of these miners. I don't know why they don't own CleanSpark. That's odd to me, but I'd be curious as to why. Anyway, they've clearly done their due diligence, right? They like these companies for some reason. I would show you MinerMag. I don't know why it's down, probably because I'm doing the video, but theminermag.com has the best data free, assuming this website isn't gone. Their Telegram channel is also excellent for headlines and news in the United States, globally. So definitely check them out. They're going to be your top resource for any of the fundamental type stuff, where I pulled some of this data from yesterday when the website was up. You've also got non-crypto natives doing research on miners now. It's interesting, in October, JP Morgan also said they like CleanSpark a lot. So from the fundamental business part, which for me is not a strong suit from the analysis, right? I would rely on stuff like this to just read it and see if it aligns with your expectations, right? It won't always, but in this case, I think in my case, it did. So as far as some of the other things to consider, difficulty, right? Difficulty is only up and to the right. This is going to squeeze out the smaller miners. This is going to make it harder for the smaller miners to make increasing growth revenue. They're going to have to seek other means. They're either going to have to get acquired or, fail, basically, right? Sell off, get merged with. The biggest miners will have to continue buying ASICs, getting ASICs, deploying ASICs, right? Just to keep up, just to keep their market share, especially after halving. This was China bans Bitcoin, by the way, down here. Well, China bans Bitcoin mining. We are so far away from that at this point. We're light years. This is log, I think, right? Yeah. If we go to linear, it's parabolic. So mining is a tough business, and it's only getting tougher with globally. We're just seeing random places: Ethiopia, Africa, places in Europe, places in South America, Tibet. It's everywhere where we're seeing more and more mining. So it's just getting harder and harder for these businesses that exist to maintain their foothold as a percentage of the difficulty or hash rate in the network, right? As far as the publicly listed miners, it's a good idea to have this kind of cheat sheet spreadsheet if you're trading them. Like, where are they located? Physically, where are their sites? That's important. I didn't fill this out because I'm lazy, but you get the idea, right? Who's their custodian? Doesn't really matter until it matters, but it matters, right? So who has Marathon's custody, right? They have a lot of BTC. I don't actually know off the top of my head, but something to look at. One metric I talked about in the last video was market cap relative to hash rate. To me, the left curve analysis is, can this thing succeed as a company, as a business? And is it undervalued or overvalued relative to market cap per hash rate? Okay, assuming I did these calculations correctly, which I think I did. Iris down there to me sticks out as one that's undervalued. You'll notice at the top, we're all kind of about the same here in the 35.35 whatever per whatever, right? And this calculation does not take into account BTC held. So if you did that, maybe you'd say, well, Marathon's actually undervalued here because they've got double the BTC as Riot. They've got 5x the BTC as CleanSpark, right? So just things to think about, even amongst the leaders. If we look at the difference between December and now, as far as the change here, I think it's natural to see these businesses maybe get more expensive relative to their hash rate in a bull market. But what I don't like is things that get extremely cheap, like Hut. Looking at the TA is something I don't think I would touch. I'll talk about that in a second, but just another way to slice and dice this, right? And you can see the favorite of last video got much more expensive based on this metric. And most of these market caps increased by quite a bit. Marathon, the most, obviously. Looking at WGMI for a second, if you look at the holdings there, again, it's what you'd expect. I was actually surprised to see Iris all the way up here. So Bill Cannon at Valkyrie agrees with me that maybe this is a decent company to hold onto if it's in their top holdings. CleanSpark running away with the weight based on the price, most likely. This does have allocation caps. I can't remember what they are. I'm guessing it's around 20%, as in, this would have to be sold and rejiggered a little bit because it's overweight CleanSpark. But we've got some chip companies in here. We've got NVIDIA, TSM, Samsung, AMD. And you can see at the bottom of the list here, the more YOLO type things that as an individual investor are extremely risky. There's a small slice of the pie as a percentage. So if you like this basket or this mix of stuff, it's out there as an ETF. It does have an expense ratio, like I said, but it's a very tradable vehicle if you just want a broad basket of all the miners. The alternative, of course, is, if you say, I just like 3 or 4 of these, I'll stick to those. I think NVIDIA's overvalued or something. I don't want any of that. I already have enough NVIDIA in my portfolio. Then you don't want more through WGMI, right? But if you don't want to have to deal with individual names, you can just buy the basket and be done with it. When we think about fees for miners, one thing that drove miners higher last quarter and last year were ordinal NFT fees related to minting, on-chain activity, that sort of thing. Based on what we've seen so far, based on the on-chain activity, there's kind of been 2 spurts of excitement, right? My guess is we're probably going to continue to see these mini manias of ordinal activity, but thus far it has not been sustained. So from a miner revenue perspective, in the near term, we're not seeing that pick up again. So this is another hit against revenues in the near term relative to halving. If you're losing half of the total BTC that you're mining and you're not getting all of these fees, you're taking a pretty big hit. The other side of that equation, of course, is Bitcoin price. So Bitcoin price can increase and make up the difference, but I think that's got to increase, by 2x plus at this point. to make up for the difference. So just something else to think about. Miner revenue over time, this is in BTC, continues to decline. But as long as price is increasing from the miner business perspective, they'll still do okay, right? So again, what they want to see is rising prices, rising fees, and we can look at those periods of time where the fees have been substantial relative to the reward, and we just had one of those periods. So for the miners individually as companies, they want to see ordinals coming back. Whether or not they agree with what's going on or not, from a miner revenue perspective, as a trader, as an investor, you want to see this as well. Just another reason to pay attention to that in the periphery. As far as the treasuries of the miners themselves, bitcointreasuries.net, great resource for that. If you want to check this information, it's all right there, right? You can see it all relative to everything else. MSTR, Coinbase is on here, everything. ETFs are down there as well. And then if you want to look at the on-chain metrics, CryptoQuant's a pretty good semi-free resource for this. Miner reserves have actually fallen substantially throughout 2023 to present. So assuming we can trust this on-chain data, this is honestly what I'd rather see. I'd rather see miners sell into strength continuously and not wait till the bottom of the market to sell a bunch of coin, right? Which is clearly what happened, what helped push us lower in November 2022 based on this data. In the sort of micro trend near term, it's important to watch the flows a little bit. Again, you just want to be sort of aware of this stuff, especially if you're trading Bitcoin price. If the miners are unloading tons of BTC at maybe a price sensitive area at some resistance or something, that's going to hold us back more. Just another thing to minimally pay attention to. And then we've got people like Mara who not only are not selling all of their mined Bitcoin, but they're buying Bitcoin, right? Which I don't necessarily agree with, but good for them. They're basically double or tripling down on expectations for higher prices. So you certainly hope that the upside in Bitcoin price would be reflected eventually in the price of the stock. A distant far out thought years from now is, does somebody eventually just acquire a company like Marathon for the treasury, right? Maybe they don't care less about the mining piece. Maybe they spin off the treasury and that gets acquired, because that's a hefty chunk of BTC at almost 16,000 BTC. But Marathon clearly ready for the bull market. We talk about geography in the United States. This is a good map from Luxor a few quarters back now, but close enough. The size of the dots are the size of the mining footprint. As you can see, most of it's Texas, most of it's the South, a lot in upstate New York, a decent chunk in North Dakota, and a decent chunk in Washington State, thanks to hydro. Texas, you've got cheap energy generally. You've got ERCOT. You've got cheap nat gas. There's a mix of hydro and nuclear here in the South and in upstate New York. So I think it's just important to know what you're getting yourself into geographically, where these are located, because you're going to see headlines of regulation, acts of God, all the weather in Texas that they were having. That certainly affected their ability to mine because they had to shut off. Now ERCOT paid them for that, but again, just important to know, what's going on there. We've also got the US government wanting data on crypto mines, how much energy they are using. And as many have sort of hinted at, Dennis Porter being a very pro Bitcoin mining advocate, hinting that this may lead to taxing miners, running them out of the country, confiscating them, stuff like that. Like, yes, is all that possible? Yes, sure. Likely, I don't know, but you should pay attention to that risk, because if one day we get some executive order that says XYZ miners, that's going to hurt your investment in the miners. If we look at where miners may go, this is a nice interactive map on electricity costs. Now, it's more than just electricity, right? They need physical space as well. But some of these states, I think New Mexico is probably the most surprising. Based on this data, electricity last year was the cheapest in New Mexico. I don't know if that's because of the nuclear energy footprint, not quite sure, but you may start to see miners in New Mexico. Heat is another consideration. Humidity is another consideration. So usually there's a reason why mines are placed where they're placed in the United States, at least. If you look at the hydro stuff, right? Georgia, CleanSpark, I think that has a big mine there. There's a lot of hydro in Washington State, obviously big hydro footprint in upstate New York, which is why a lot of miners went there. So all this stuff kind of makes sense. looking at the nuclear piece, it's just no contest as far as deaths per emission, however you want to think about this. We can talk about Chernobyl, Fukushima, 3 Mile Island, XYZ disaster. I think it's easier to see those individual data points and events and harder to understand how harmful coal, oil, natural gas is relative to nuclear. That's just me. I'd rather take that calculated risk than what we've seen historically with coal. So that's my pitch on nuclear. And if we look at nuclear in the United States, concentrations in Illinois, Pennsylvania, some in the South here. And so as a miner, you kind of need these Goldilocks places, right? Cheap energy, friendly regulatory environment, space, places to mine that are relative to these power sources. So if you map all this together, it makes sense where the miners are. Something I found months and months ago now. This is a Doomberg tweet thread on Line 5 through Michigan, and it's a natural gas oil pipeline? Oil and gas. We'll call it oil and gas pipeline through the Great Lakes, which I think is an absolute disaster. But we're apparently approving that in Michigan. On the flip side of that, we're also approving nuclear power plants. So it'd be interesting if we start to see more and more miners gravitating towards these nuclear power plants, because to me, that's a no-brainer. As far as other issues with miners, if you're unaware, they're incredibly loud. There's basically a story like this every day. We cannot put mining operations near people. It just doesn't work. Fans are loud. ASICs are loud. Everything about it is awful. Okay. So yes, it's clean. It's not dirty, but it's noise pollution like, whoa. This is Texas. This is Pennsylvania. This is Texas again. This is Arkansas, right? It doesn't work. I'll put these in the description, but this was Virginia Beach a couple of years ago. I think this one actually shut down. And then we've got another one here from Niagara Falls, a story not too long ago. So the last thing we need on the Bitcoin front is to piss off Main Street, okay? And we don't need to give them ammo to hate us even more. And this is really good ammo because it's obvious and it affects everyone's life. And you just see story after story like this in North America. Complaints lead to regulation. Regulation runs you out of the area, locally, the state. And then eventually it bubbles up to federal regulations, right? So you definitely got to be careful with that. New York sort of tried to run all the miners out of their state. Again, something to pay attention to if you're investing in a specific miner, you like a specific miner. You need to dig deep. Where are they located physically? Are they exposed to regulatory risk? Because we are in the early days of these miners getting hit with regulations left and right for all sorts of reasons. Electricity consumption, noise. In the Finger Lakes, specifically, it was the temperature of the water coming out of the nuclear plant that they were having issues with. It's a little bit of NIMBYism as well, especially in the Finger Lakes. I've been there. I've lived around there. I love wine. I don't think that a power plant that already exists is going to affect the microclimates of that area, but that's just me. There's a great story on that. This was a while back now. And really what it comes down to over time is letting these plants run that are slightly cleaner than other options, which are carbon-based, okay? And they kind of say it here. I'm just highlighting all these stories because we've built up a lot of bad press on the mining side, right? So there's lots of reasons why these miners are going to get run out of town. There's been not a lot of good press. As far as the AI piece, this is just one I saw a couple days ago with Iris. Just another reason, maybe this signals they don't think they can be successful post-halving. Maybe this signals being mediocre at mining and being a master of none relative to success. I don't know, but AI is hot right now, and if they can hook onto that story, I think that helps them more than that hurts them. David Pan is the writer for Bloomberg. He's a great follow on the mining side. Just another example, Ethiopia, right? We just saw this story last week as well. So there's a lot going on globally in the mining side. I think it's super interesting. It's definitely worth paying attention to if you're investing in this. And again, the Telegram channel with the Miner Mag usually has all these stories. If you want to get plugged into that stuff. Let's talk about alpha and beta and some charts here. So when we're looking at these miners, we're looking at past performance, right? We're not looking at the future. We don't have a crystal ball. It's important to keep that in mind. The past is different than the present in a few ways. You'll notice a lot of these miners in pre-2020 were basically in the dumps, right? So the percentage move, it was like, 16,000%, 1,500%, whatever, right? going into this halving, these miners broadly aren't on a race to zero. They're doing quite well. And so I think that may hurt their potential overperformance on the beta side. When we talk about alpha and beta, alpha is relation to a benchmark. Beta is relative to the whole market. This kind of breaks down a little bit in crypto, but you can kind of think of it as performing better or worse than BTC, being more or less volatile than BTC. There's an equation for this, covariance divided by variance. I broke that down. We'll look at that in a second. Just another reason to be aware of this, right? And just not to jump whole hog into all miners. And just to break it down simply, alpha measures excess return relative to the benchmark. Beta measures sensitivity to the market movements, indicating systemic risk. So if we look at the miners relative to Bitcoin in various periods of time, I picked this specific date because that's when WGMI started, 2/8/22. I think it's a fine date. It captures the downtrend, but you can always look at this previous bull market to now, previous bear market to now, 4 bear markets ago. The problem with a lot of these miners is they were SPACs, so there's not a lot of data as far as what you can use. I think 2023 as a year is a great example of measuring beta. You can see MSTR here. To me, surprisingly, it's actually more volatile than BTC, whereas coin is actually, as the measure, it's less volatile than BTC. In 2023, broadly, all of the miners were more volatile than BTC, with Marathon being at the top there. 2024 to present, Iris Energy is the most volatile relative to BTC based on the calculation. Don't have a lot of data for this year, but just as an example, Greenidge Energy also up there. So the miners broadly very volatile relative to BTC. So you just got to know what you're getting yourself into. I have this all in a Google Doc. I'll put it in the link of this video. All right, so we talked about fundamentals a lot. Let's talk about TA. If we just look at 2023 to present, and we put all the miners on this chart, we put Bitcoin in the orange here, 212%, 2023 to present. MSTR overperformed, coin overperformed, CleanSpark, Bitfarms, crazy overperformance relative to BTC. So this alone is an example, not even post-halving, where here's WGMI, by the way, just as a basket overperforming. So this is the argument to include this into the portfolio as a piece of the allocation, right? Now, the losers or the underperformers relative to BTC, some of them are nowhere near anywhere in the ballpark relative to performance, right? And if we dig back even deeper, again, this is WGMI inception to present, Bitcoin here at 18%. Some of these miners still essentially in depths of bear market relative to those highs when the wheels came off the wagon in 2022. CleanSpark up here, mega overperformer relative to everybody. So clearly they're doing something right, relative to Gree or Miggy or Stronghold or TerraWolf, right? And that's an argument for sticking to the miners you assume are going to be strong. Marathon, Riot, CleanSpark. It's hard because we don't have multiple cycles with all of these miners. So I think a lot of the data that uses like previous halving stuff is tenuous because we don't really know. We didn't have ETFs back then. We didn't have this amount of miners back then to trade. So I think it's really hard to extrapolate future gains relative to last halving. It's a data point. It's all we have. I get it. But I think it's tough to just assume we're going to see some 15,000% move on Marathon again. I'll start with WGMI, which has traded pretty technical since 2023, at least based on the cloud. Now, it's hard for the cloud to pick up these extremely quick moves and trend. I certainly liked the edge-to-edge move here on the daily. I let go of the position somewhere in 15-16 range just because it pulled back significantly. I like seeing the volume pick up a lot. I like that we're above the daily cloud. I like that we've got arguments for bullish reversal and or bullish continuation, depending on how you want to look at this based on chart patterns. You've got a mega inverted head and shoulders. You've got a potential for a cup and handle here. So trend metrics likes this, chart patterns like this, going higher. And we're also pre-halving. So you've got that on your side as well. Both of these patterns kind of point to 25 to 30 range, 25 to 33. So as a trader, I would like anything from here to 15, a 2x from that, right? One other thing you can do is look at this on the 4 hour. Just eyeballing this, it's picked up the trends quite well. It's kept you out, in August 2023, kept you out earlier this year. So if I was trading around this, I would look at the 4-hour. If I was trying to catch the bigger moves, I would look at the daily. We can also look at this relative to Bitcoin. Again, you can look at all these relative to Bitcoin. If you're not sure, should I rebalance? Is this overvalued? Can this go higher? We don't have a lot of data, right? So we just kind of have to make do and use what we got. There's an argument that post-halving, we just bust out of this channel and we do see crazy upside. The other argument would be maybe rebalance at the top of this channel back into BTC a little bit. Just something to consider, to look at. Based on technicals on trend, this is teeing itself up for a daily breakout. So this would suggest miner strength relative to Bitcoin is just getting started, basically, on technicals. So if any chart doesn't look like WGMI, okay, which they're not all exactly the same, but if you've got a chart that's below the daily cloud, below the weekly cloud, not keeping up at all, right? If this is your benchmark and you've got charts falling below that, as we do at the end here, to me, those are just avoids. I don't want to sit in something and take a gamble on an unsuccessful company that's already a tough business, pre-halving, yada, 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 right? I like strength. I would rather buy strength and focus on that. If you look at Marathon, much cleaner case for a inverted head and shoulders that sort of played out. Maybe even a cleaner case for a cup and handle up here or whatever. Above the daily cloud. Chart looks great. As a buy and hold, looks excellent. Even on the weekly, you can see last halving how Marathon was, I don't know, at 20, what is that, 35 cents? 35 cents to 60? I mean, that's an insane move, right? I'm lazy, so I don't know exactly when the SPAC date was or whatever they did here, but it's something to pay attention to. As far as now, we're almost through the weekly cloud. This looks like an easy buy and hold if you're bullish miners, if you're bullish post-halving. This one's going to survive, right? This company isn't going to get regulated to death. It's not going to lose its foothold in the zero-sum game of mining. They're going to do okay. I'm not really worried about Marathon. Even on the high timeframe cloud relative to BTC, this to me looks like an inverted head and shoulders. This looks like, on a relative basis, Marathon's ready to take significant moves higher based on the cloud, based on trend. So Marathon looks really good to me. Riot also trying to get out of the weekly cloud here. Looks fine. Again, last halving, mega move, right? And certainly everyone's going to be looking at that and talking about that. Daily cloud also looks fine. Daily trend looks fine. I don't see any issues with the charts that look like this. What you don't want to see specifically with Riot is any lower low, anything below 10, right? That's really a bad sign. With Marathon relative to BTC, what you don't want to see is a new low on this chart, right? The expectation is bullish continuation. If that fails, much like this head and shoulders failed, which was bearish continuation, you see a very strong opposite reaction. So just something to pay attention to broadly. You don't have to top tick and bottom tick it, but you don't want to be in this black hole of doom expecting to outperform BTC. Here's CleanSpark, and the volume's just been unbelievable on this thing. It was up, I think, 35% a day. It was up 100% in 5 days. Just wild, right? I'm zoomed way out, but clearly it's out of this downtrend. Clearly it's holding above the cloud. It invalidated a head and shoulders that many miners had late last year, and potentially has the inverted head and shoulders here. It's tough because it's just been straight up, straight down, kind of back to back over and over again. But it still looks good to me. It should do well in the long term. It's clearly going to be a winner relative to all the other miners. They are not really in Texas. They're more in Georgia from memory. But again, I would diversify out of just Texas, just New York, just Washington State, just North Dakota and Miami, Montana, right? You never know. So definitely want to keep that into consideration. On the weekly, we are already above the weekly cloud. This looks great. By the way, I'm using 1852, 104.26. The legacy doubled for all these clouds, but CleanSpark looks phenomenal to me. CleanSpark relative to BTC even has a bullish breakout on the weekly. So CleanSpark looking very, very, very strong relative to other miners, relative to Bitcoin. Cipher mining kind of stuck in this range. Cloud doesn't love it or hate it. I'd rather buy strength than range personally. So this one for me is kind of an avoid in the moment. Weekly cloud is getting there, but post-halving is going to be D-Day for a lot of these miners. So I would watch, revisit something like this post-halving. At least that's what I'll be doing. HUT, like I said earlier, doesn't look like WGMI, doesn't look like Mara or Riot or CleanSpark. It's making lower lows here. That might be, the low might be in, right? I don't know, but I'd rather buy this and pay attention to it when it's back at 18 than worry about whatever the heck it's doing down here. So this one's also in a void for me in the moment. And the weekly cloud, you can see it's nowhere close to a breakout. Still very much just broadly ranging. And comparing that to the market cap hash rate metrics, something is probably going on here that I'm not investigating deeply enough. But if I had to guess, there's some issues with the company itself. BitTier, anything that's ranging, just not for me. There's plenty of options to look for to buy strength. This isn't a void for me, big time. TerraWolf actually looks great on the daily. Fresh daily Kumo breakout here. Almost daily TK cross, bullish TK cross. Doesn't look horrible. The fundamentals of the company, probably a little bit suspect, but I think that's one of the ones that BlackRock owns. I could be wrong on that, but something to keep an eye on. I'm not going to touch this here. I'd prefer this 6 months out, see where it's at relative to the weekly cloud. Doesn't look bearish on high timeframes, looks better on lower timeframes. Iris Energy, not a lot of trading data. Again, I don't know if this was a SPAC. I can't remember what day that was, if that happened. Doesn't look like it was. Broadly on the weekly, this is teeing itself up for a weekly Kumo breakout, eventually weekly inverted head and shoulders. As long as it doesn't make a lower low, still looks really good on that time frame. On the daily time frame, it also has a bullish TK cross bullish Kumo breakout, bullish Kumo, bullish cloud, almost a bullish TK cross. Anyway, all this potentially looks decently ready for a breakout. It looks better to me than Cypher. It's range bound, but it's not as range bound. And maybe you want to revisit this at 8 or 10, right? But to me, this looks like it's setting itself up for a decent move higher. Hive looks okay. Maybe you set some alerts on this diagonal resistance, trying to get itself above the daily cloud. But again, you don't want to see lower lows on any of these charts. Weekly needs more time, not quite above weekly cloud yet. So I hope this is helping you get some sense of trend technicals, at least the way I see it. We're a little ways out. And to me, the cloud is kind of signaling what probably many people are thinking, like, can this individual name survive post-halving, right? So you definitely want to look at cost to mine pre and post-halving, because that's going to be the difference maker for a lot of these miners. Cloud here just says wait, ARBK on the weekly, trying to get into the weekly cloud, ranging, ascending triangle, looks okay. Don't love it, don't hate it. DMGI, trying to get out of the weekly cloud, don't love it, don't hate it. We'll know after halving, definitely, how many of these companies are left, right? Just another reason to stick with the larger names. This is Stronghold, kind of looks like Hood. It's had this pretty tight range. I would just set an alert for like 850 and see what happens, but not something I'm buying all the way down here. DigiHost ranging, no real momentum here. We'll know by mid-year what's going on there on the weekly. Bit mining looks okay. It's coming into the weekly cloud, bullish TK cross. It has an ascending triangle. Doesn't look terrible. I just think you're better off playing the names that are safer than worrying about, like, can this company survive the next 6 to 12 months? Mawson Infrastructure. This one had a bunch of issues. I can't remember off the top of my head as a company, but trying to get into the weekly cloud. This looks like a lot of alts do, honestly. Tried to bottom. Maybe it's a triple bottom. Maybe it's an inverted head and shoulders, similar to Sushi. You're probably better off waiting until it makes a higher high here. So you just set an alert for $3 or something, right? And come back to it. But I would not stick around and buy weakness at all. Here's one I bought 100 shares of the other day, just because it's literally at the bottom of the stack. Maybe the highest risk reward, I don't know. But Greenidge Energy, GREE. On the weekly, it's also trying to get into the weekly cloud, right? Maybe this is a triple bottom. Maybe this fails. It's not a good omen that it made a new lower low here, but you're definitely better off waiting for an alert, maybe at 8, 9, 10, whatever that is, to be safer. And against BTC, doesn't look great, right? You want to avoid stuff that looks like this. You want to avoid this bottomless pit like Zcash, right? So I know this was a long one. I know a lot of people have been wanting me to cover miners in a deeper way. A lot of things to consider, a lot of things to think about. For me, I'd rather just look at the TA, but you do have to be aware of the regulatory stuff, the US concentration, the energy mix of these companies. Can they survive halving? What does their treasury look like? So I like Marathon, I like CleanSpark, I like IREN. The others, kind of take it or leave it. And then if you don't want to manage anything individually, WGMI is always an option for you. That's all for this one. Like, dislike, comment, share, subscribe, and happy trading.